Gold Weekly number 2. It's been an interesting week, this week that's ended with the beginning of June 2017, and we've seen the gold price just steadily advance, particularly in the dollar, because the dollar's been weak primarily, but it's improved in all currencies except the yuan, the Chinese yuan. And it actually broke through overhead resistance. It didn't spike higher as it used to do when it was driven simply by speculators who would immediately jump on a technical break one way or the other. No, it's just moved steadily. The 50-day average moved through the 200-day average, forming what they call the Golden Cross, which is a bullish signal. But it didn't do much by way of spiking. It's just steadily plodded with higher lows and higher highs. And what has been most noticeable is the drop in volatility. You might ask yourselves why, and lots of people are saying, why such a drop in volatility? I attribute it to the authorities in Shanghai. They have had a war on speculation, primarily both in the currency and in all their financial markets. In the gold market, at the beginning of this year, they increased the cost of dealing by making the contract smaller, 500 kg maximum, so that a speculator, if they wanted to really hit the market, would have to pay quite a price to do so. And he had to deal in physical. Yes, he could have dealt in New York or in London in physical, but arbitraging between the markets is now very much firmly in place. And it's not just in the international market in Shanghai. It's quite easy to run a book between the two centers, including currencies, and only shifting a top-heavy position into China. Of course, exports from China are not allowed. It's important for you to understand just how significant Shanghai is becoming. I personally would attribute the pricing power to Shanghai now. It's moved. So we're not now looking at Shanghai being at a premium. We're looking at London, New York at a discount. And that's a very important structural change in the markets. You might respond and say, but in the London, New York deal, 90% of all gold dealing is done in those two centres. I would take exception to that and say, 90% of gold derivatives are handled there. On COMEX, the guesstimate is about 1%. Actually, 1% of their contracts ends in actual delivery. Was as high as 5% at some point?